This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today we're here with Jack Knowles, Vice President of Venture Investments and Head of Pharma Leaps. Jack, thank you for joining us.
Thank you, Hall. Great to be here.
So what was your background before investing in early stage companies? What did you do before this?
So I've had a long zigzagging career. I started as a medical doctor, so completed medical school, did a couple years of residency in a head and neck cancer program, and then did a lot of research working in various laboratories, both where I went to medical school and then in residency. Ultimately, I decided medicine wasn't for me, so made a career switch to go into consulting with a group in New York, and then wound up working at an investment bank doing equities research. Luckily, I wasn't there very long. A headhunter found me, and I started my career in venture capital working for MPM Capital in Cambridge, Massachusetts in 2013.
Oh, great. So what excites you right now? What gets you jazzed these days?
Yeah, so I predominantly work in the biotech space. So we do some healthcare investing on the tech side, but mostly on the biotech side. I'm really excited about cell therapy, gene editing, really the emerging technologies that are just coming to deliver products to the market. And I think that space is really interesting because it really lets you get at the root of the problem. So instead of looking for a small molecule that might hit a particular pathway or hit a particular target, you can really design therapies from the ground up to go after the biology that's inside all of us. So that part is really exciting to me, and it's an emerging field that's just starting to bear fruit.
Great. So what's your advice for people investing in startups in the biotech sector? What do you tell them to do before they write that first check?
Be prepared to write another and another. Biotech investing is very capital intensive. And so I think for a lot of generalists, it's a space where they can get into trouble very quickly. I've seen this happen, especially with people coming from the tech space who might be less sensitive to higher valuations, and they tend to view cash burn as a kind of a way to success, right? If a company's burning a lot of cash, it must mean they're hiring a lot of people, which must mean they're executing on their vision. In the biotech world, you can spend a lot of money just with outside groups, which we call contract research organizations or CROs. And so frequently you'll have biotechs spending cash for others to do their research, whether this is with animal models or even in vitro experiments. The challenge there is, of course, that if you're hiring someone else to do these projects and they don't work out, you don't have a lot of institutional wisdom left as a result. You might not be aware why the study failed. You might not have thought through what improvements you can make. And all the people who actually did the work are inside the CRO. So I've seen a lot of biotech struggle by spending a lot of cash early and then not having a lot of positive data as a result.
And so for people on the other side of that table, those who are starting biotech companies, what's your advice to them before they launch that business?
You really have to think through a differentiated approach to the market. It's a very crowded space at the moment. There are a lot of Me Too companies out there. There are a lot of people trying to stand out and make noise. Story is very important, but equally, if not more important, is actually having a business strategy that makes sense. And that encompasses things like intellectual property, making sure your IP portfolio is strong, making sure that your collaborators, so the academic founders or SAB, Scientific Advisory Board, be strong, making sure that the target you're going after. So we see a lot of people, especially in the cell and gene therapy space, sometimes go after diseases where there's not a lot of unmet medical needs. So they'll be looking at a gene therapy to treat, I don't know, something like infertility or something like low sex drive. That's not an area of high unmet medical need. And it's much harder, I think, to get drugs approved if there's a potential for bad side effects or negative sequelae if you haven't really established that there's a huge need there. So I tend to focus in areas like rare disease, Duchenne muscular dystrophy, cystic fibrosis, places where kids are really suffering, patients can really use a benefit, as well as indications like cancer, where people are usually looking for anything. They've failed the frontline and second line therapies to have an impact. I think in those areas, you can really make the argument that the disease burden is so high that taking risks on some of these next generation technologies can make sense.
Great. So let's talk about the state of investing in biotech.
How is the industry evolving and what changes do you see coming up?
Yeah. So, like most of the world, we've also been in this 11-year bull run that's now come to an end. For a while, it was very difficult at the very beginning of my career to get companies financed, to get out in the public markets and IPO. I started my career around 2008, 2009, when we were in the beginning of the recession. And we've seen a few dips since then, right? 2012 famously also was another time where it was hard to get financing on the public markets. And I think we're going back into that as of this past week with coronavirus wreaking havoc. None of the companies that I'm aware of that were planning to IPO is clearly not in the plans anytime soon. And even some on the private financing side, I think, are starting to tighten up. Folks who I know were planning on $100 million rounds now punted, and they're looking at closing those rounds 6 months from now. So those that can raise money in this current environment, I suggest they do so, do so quickly. I think a lot of the capital markets will be drying up, and I think there'll be a lot of companies that fail as a result.
Yeah, so the cycle continues as it has before. It looks like 2008 all over again, but life does move on. So let's talk about your investment thesis at Leaps. What exactly do you guys look for, and what is your thesis there?
Yeah, so Leaps is a relatively new corporate venture entity. We were started in 2015. And the basic idea behind this was to be bold, to be creative, to really go for the high-risk areas. And the thinking behind that at Bayer was that Bayer had missed out on some of these first-generation technologies in the cell therapy space like CAR-T and some of the early immuno-oncology assets like PD-1, PD-L1 inhibitors. So Leaps is really created to think big and think 10 years ahead. So look at technologies like gene editing. So we were one of the lead investors in CRISPR for its crossover and IPO. We have a joint venture with CRISPR called Casibia. We've also invested heavily in the induced pluripotent stem cell space. So these are adult cells that are turned into stem cells. So no issues with working with reproductive material. And then you can take those cells that are reprogrammed to stem cells and push them into therapeutic cells. So we've invested in a company called BlueRock, which is doing induced pluripotent stem cells for Parkinson's. They can make a new neuron that can actually secrete dopamine in the brain. They're also working on a potential cardiomyocyte, so a cell you could give to patients who've had heart failure or heart attacks and actually regenerate their heart tissue. And we've also invested in a company called Century Therapeutics, which is based in Philadelphia. Century is taking these same induced pluripotent adult cells and turning them into T cells, which are part of your immune system, or natural killer cells, also part of your immune system. And the hope is to really be able to take these cells and have them be the drug product. So you can imagine going to a hospital with a recent diagnosis of cancer, and instead of going through chemo and radiation and surgery, even you might be able to just hang up a bag of these natural killer or T cells and have them honed to the side of the cancer and take care of it for you. So at least we really focus on those kind of next generation transformational approaches. We've also invested in a company called eGenesis recently. This is a company that's looking at using gene editing to turn pig organs into organs that can be transplanted into humans. And so this is something called xenotransplantation that's been science fiction for more than a couple decades now. But the current emerging technologies are really allowing these technologies to potentially come into vogue. So we're very excited about being one of the forefront and leaders in these spaces, and we'll continue to make big bets on early high-risk technologies.
Great. Well, just to dive into that a little deeper, most corporate strategics are not about the financial return, but about the additional returns, the education, the experience, the information, et cetera. How much does that work with Leaps as far as what's the dividing between financial return versus non-financial return, and what drives decisions to go after those?
Yeah, that's correct. We are a corporate VC, and the goal, I think, of all corporate VCs is to serve the strategy of their corporate parent. And those strategies are different, right? Some people do prioritize ROI. They want a venture fund that's out there showing that they can create value. At Bayer, we're not judged on our IRR, so we're not looking at investment rate of return as something that is a metric we're judged upon. We are judged on how well we fit within the strategy of Bayer and how well we kind of anticipate and serve the needs of a growing multinational organization. So in that respect, we try to align with the business units. We spend a lot of time talking to pharma, talking to the oncology group, even on the crop science side and consumer health, and really understanding what technologies and businesses they're interested in. And as you said, the goal is to ultimately get access to these technologies. So how we do that is to think about using money or investment capital as a weapon, right? We either say, hey, we want to own a big chunk of your company so that if you do generate positive data, if you have a technology that looks like it's working really well, Bayer is in a good position to acquire that entity. So this is what we did with Blue Rock, the cell therapy company I mentioned previously. We started that company in 2016, and then we bought it in 2019. And that was enabled by Bayer having a relatively large position, about 40% of the company. The other way we do this is by structuring strategic rights. And these can't be hardwired rights, so we can never predefine a purchase price or compel a company to sell us anything. But if possible, we like to put in the stock purchase agreement a right of first refusal, maybe a right of last matching offer for one or several of the assets the company is working on. So in that way, we really hope to kind of give Bayer multiple shots on goal. We get exposure to the company at the board level, so we get to learn about the technology. We also own a larger equity percentage, and Bayer wants to buy it, it can. And then if individual programs become of interest, we like to have some soft rights of first refusal to negotiate for those programs.
Very good. Very good. So let's talk about the startups in these spaces that you deal with. What are the challenges they face in running their business? Is it just FDA validation or is it other things?
It's anything and everything. I mean, I've seen the issues with just, bad financial management, companies taking out loans or doing deals that don't make sense. I've seen some experimental design issues where companies are kind of pushing in one direction, getting data in a large animal model perhaps, but that's not necessarily always helpful with FDA, especially in cancer indications. There really is no model that's really great when you're trying to develop something for humans and human cancers. So I think companies can run into trouble all over the place. The biggest one is always money. I mean, as I mentioned at the top of the call, biotech is really expensive and companies will frequently not give themselves enough runway. And as we're seeing now, macroeconomic trends can really dictate what's available on the capital markets. So if you're getting into a place where you have bad data or something hasn't worked, and now you've only got 3 months of cash left to operate your business, you could be in a pretty bad problem. I mean, it's hard to go out and raise money like that from a position of weakness. Frequently, you'll see the VCs who will fund you look for terms that are not company friendly. They'll try to take over the board. They may ask for certain concessions on the financial side, like certain liquidation preferences that might not be great for the other investors. So companies really need to be mindful of their balance sheet and how much cash burn they're going through, and really plan ahead. I always like to make sure my companies have at least 6 to 12 months of runway ahead of them. And as soon as they start dipping below that, I strongly encourage them to either reduce spend dramatically or go out and raise more money.
Very good. So you see a lot of applications and subsectors out there in the biotech space. If you had to call out one or two as good immediate opportunities for investors to pursue today, what would you call out?
Well, I mean, everything's pretty low right now in the stock market, so you can throw a dart and hit something that's probably undervalued. I think in our industry, oncology and rare disease, they have been for a while, but I think they'll continue to be the areas where you can find interesting opportunities. I think a lot in the gene therapy space these days. There are companies out there that have been acquired recently, like Spark, was by Roche, or Astellas acquired our dentist recently as a gene therapy play. I think big pharmas are looking for these kind of plug and play platforms. And so if there's a biotech out there that's working on a platform technology, whether it be cell or gene therapy, I think, as long as their strategy is right and they've gotten a product significantly close to an approval, they become an interesting acquisition target. I think the other area where there's a little bit of underinvestment, or I should say things that may be oversold, in my view, is on the medtech side. There's been a bunch of consolidation in that industry, and it's not my area of expertise, but I have seen some interesting opportunities out there that seem to be undervalued just because there's only a few buyers at the top. Finally, I'll say on the pharma side, I'll give a plug for Bayer. We've taken a beating ourselves after the Monsanto acquisition, But if you look at the share price right now and the market cap of our group, it's significantly lower than what it used to be. And I think as we come out of litigation, and again, I have no inside knowledge here of what's going on, but I think we're an interesting opportunity as well. We're one of the biggest crop science companies and have a very strong pharma group pulling right behind it.
Very good. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
Nothing. I mean, I think I'm based here in Cambridge and Boston, which I think is a wonderful ecosystem. Spend a lot of time out in California and the Bay Area as well, and would be happy to talk with any of your listeners who would like to learn more about biotech or EPO.
Great. Appreciate you making that offer. How best for listeners to get back in touch with you?
So you can find me on LinkedIn, also the Leaps by Bayer website, which I think you'll put a link to. And in this is a great way to find me. My email's on both LinkedIn and on the Bayer website. So feel free to reach out there.
Great. We'll add those to the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Great. Thank you so much, Paul.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall-T Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.